But all right, it is almost 11:15. I see my man Thomas Hayes hanging out backstage. So without further ado, let's go ahead and give Thomas our very special Zinger Nation welcome. When we come back, we'll see what Thomas thinks on the market right now. See maybe if he'd be buying the dip on some of these chip stocks, and as well as some other trade ideas. All right, welcome Thomas Hayes back to Benzinga Live. Thanks again for hopping on with us today. How you doing?
I'm doing great. Thanks for having me, Aaron.
Of course. So, give me just your top of mind, like overall market outlook right now. I know you were bullish for a while when, a lot of people weren't bullish on the market. Do you still have that same mentality, or do you still have that positive of an outlook on the market right now?
Yeah, well, Aaron, it certainly was lonely. October 22 and even October 23, everyone got bearish as well. And there were a lot of major names that have since either flipped bullish or found new jobs. And when you see those kind of last holdout bears flip bullish, it can be reason for pause in the short term. I think generally looking out, we're very, very constructive, but I think we're moving into a period, as a lot of people know, generally on a monthly basis, seasonally, the end of February tends to be weak. There's no real catalyst. Earnings season's winding down. Earnings season was much better than expected. 2.9% earnings growth versus 1% earnings growth expectations. So you have some seasonal weakness. And then in an election year, this tends to be the period where you get weakness in February and in March. The only thing that worries me about being short-term cautious and long-term constructive is that quite a lot of people are looking for this 5 to 7% pullback in the next couple of months between now and April. To position for that last week, we put on a hedge for the portfolio. We did some short-term dated put spreads on the S&P. And the reason we did that is a fewfold. First and foremost, we don't want to sell any positions in our portfolio. So we're long and strong because there isn't a position in our portfolio that we believe has reached full intrinsic value. We know where we want to get out of a company before we even get in, and none of them have hit those levels. There were a couple we could have considered selling calls against, but I don't like that. If it gets called away, you get a taxable event. So we wanted a situation where we could dampen volatility for clients. And if we're right, that 1% of equity capital that we have as a hedge, the expected value is 5x. So that would become 5% equity capital. And that gives us a lot of money to add to be long into the end of the year, because on average in an election year, Aaron, since 1928, the S&P is up 11.28%, and we believe that's going to be the case this year. So very short term, February, March, April, maybe we get that 3 to 8% pullback, and that's why we have the 1% of equity capital as a hedge short. But I think through the year, if you just sit tight and did nothing, you're going to have a great year. Up 9, 11, 12% on the indices, and much more if you're doing a decent job picking stocks.
Got it. So in the short term, you're a little cautious and you think we might see this pullback, but overall, if you then zoom out to the whole year, you're still pretty generally bullish.
Yeah, unequivocally.
Got it. And I do have, you were talking about how some of these bears are now flipping over to the bull side. And it's funny too how a lot of the perma bears, like, the bear case keeps changing, right? For a while, oh my God, rates are at 5%, and then rates are at 5%, and the economy is fine. And then it's, oh my God, then something else, and then this geopolitical thing. And it's like, hold on, if you're going to keep coming up with a different story of why the market's going to come down, then you're kind of losing me over there versus people that have like stuck to, this is why the market's going to be fine. And then, but I do have these numbers. And it's interesting. This is from the AAII, the American Association of Individual Investors, just the bullish versus bearish sentiment. And like you mentioned, October, November 2023, you can see right here, that was our 1 year bearish high on this rating, and it was over 50%. And that was just a few months ago, November. November 2023 was less than 4 months ago. Now it's almost completely flipped, and you have 42% of people that are bullish and basically only half, 26.8% of those people that were bearish. So you've seen, I mean, a lot of bears now leave that camp.
Yeah, and I think the key thing here, Aaron, is we have to keep in mind, even though maybe we get this pullback, maybe we don't in the next few weeks, we've had 2 years of sideways consolidation, namely 0% gains. So we've just broken out of a 2-year consolidation. Very tough to get bearish in a meaningful way here. The trend is now resumed its uptrend. I think if you do get a pullback, maybe you come back to where it broke out at 4650, 4700 range, but not a whole lot more than that. And I'm happy to be wrong, because if the market keeps pushing higher, yes, we've burned 1% equity capital, but the beta and convexity in our portfolio, if the market's up another 4 or 5%, we're going to be up a lot more than that. So yes, we lost a net 1%. But if we're right, we get an extra 5% of capital to press into year end, which could add 10 points of alpha for our clients, which is very important to us. So I like the risk reward. I think what punishes the most people, we look at the pain trade a lot, would actually be neither, in the sense that we just grind sideways and burn everyone's premium, burn all the new bulls premium, burn all the perma bears premium, and grind sideways for 3 months, consolidate some more before we resume the uptrend. That's probably maximum pain for most participants right now.
That's interesting, because when you think about that maximum pain scenario, you're typically not thinking about just sideways trading. I mean, maybe for like an options play into earnings, where it's like, okay, if Nvidia doesn't move much at all after its report, then obviously everyone buying calls and everyone buying puts are probably going to be down. But when I think about maximum pain scenario for the overall market, I'm rarely thinking about it just grinding sideways. So that's definitely an interesting kind of outlook there that I'll have to think about. Do you want to get into some of those individual names that you do like long term, and if you're if your short works out, where are you going to put this extra capital?
Yeah, no, that makes perfect sense. So first, the other thing to keep in mind, by the way, one of the key metrics we look at is the Bank of America Global Fund Manager Survey every month, which came out a few days ago. Global managers are still 1/10 of one standard deviation below their long-term average in terms of equity overweight. So there's more, as much new optimism that's come into the market, there's still a lot of skepticism. The sentiment and the outlook among institutional managers that manage about $1 trillion in this survey has risen a lot, but it's not at extremes. So I think there's more work to do on that front, which is kind of the overriding arch. We've got a few picks. As you know, we're much longer term than most. Our average holding period is 12 to 48 months. When we buy a company, we buy it when it's out of favor but cash flow positive, usually growing cash flow, or temporarily impaired and is going to resume back to its long-term cycle. So we like to buy boring businesses. I know there's a lot of excitement around specific names. It's like a moth to a flame that people just can't not participate in. A couple of years ago it was Tesla. They either had to be perma bears saying that the cars fall apart or whatever, or perma bulls saying Musk is gonna everyone's gonna be driving an electric car in two months. So we generally stay away from stocks like this. So right now you got SMCI.
I assume no. I was gonna say, I assume no SMCI then, or
no SMCI, no Nvidia. Obviously, Nvidia is hitting on all cylinders. Great company, great business, great leadership, all of that stuff. For us, though, paying 40 times sales, in the short term, it can go to 80 times sales. We have no idea. But if you just look quantitatively at data over the last 100 years, buying anything at 40 times sales usually doesn't end well in the long term. In the short term, it doesn't mean you can't double or triple your money. But in the long term, the odds are against you, and we just tend to play with the odds. But there are always exceptions, right? So Bitcoin, we missed that. It's not what we do. We only buy cash generative assets, but our framework wouldn't allow us to participate in certain things, not because they're right or wrong or good or bad, just because we know what we're good at and we stay in our lane and we let people make money tons of other different ways that are good for them.
Got it. So, I know PayPal is one of the names that you said you like. I can go ahead and pull up a chart. The report a couple weeks ago was not, I think, what a lot of bulls were looking for, but you're still, you still want to hold this company long term?
Yeah, I noticed on your profile, are you a golfer?
I am, yeah.
Okay, so I'm a golfer as well. So there's a phrase in golf called sandbagger,
Yep.
which is, the kind of guy that never records his low scores, and he says he's a 15 and he goes out there and miraculously shoots a 74 and takes all your money. Basically what you had with Chris, Alex Chris, the new CEO, was he's basically just found the coffee machine. He's been in the business for 4 months. He came from Intuit rather. While he was at Intuit, he ran the small business division, which was responsible for 50% of the revenues. That stock was a 38 bagger over his tenure, running basically 50% of the business. Wow. And he came in and he saw what we see, which is a business that's generating about $5 billion a year in free cash flow. They're now buying back about $5 billion a year in stock. And he's a master of small businesses, which is what PayPal caters to. So he came in, he saw the opportunity, and he goes on with Faber on CNBC and says, I'm going to shock the world on January 26th. And he comes out with a pre-recorded 20-minute pitch on the 5 or 6 things that he's going to do, which probably will shock the world 12 to 24 months out as he implements them, and the margins start to reaccelerate, and the cash flow goes from $5 billion a year to $7 or $8 or $9 or $10 billion a year, and people say, "Wow, what happened so quickly?" But it wasn't going to shock him in a 20-minute sleepy video. That's for damn sure. So he realized the stock went up into that. It sold off after that, and then earnings. He said, let's try the opposite tact. Instead of promising the world, let's promise them nothing. And then we can exceed expectations every single quarter moving forward. And that's exactly what he did. You have a company that beat revenues were up 9% year on year. Earnings non-GAAP were up 19% year on year. Total payment volume was up 15%. This is not a startup with total payment volume up 15% year on year. This is a company that has 10% of global enterprise spend. So people think of PayPal, they think about the PayPal button, on websites and everything else. The vast majority of the business is white label with Braintree. And so like when you take an Uber, people say, I haven't used PayPal in 6 months. Well, when's the last time you took an Uber? You used Braintree, which is owned by PayPal. You just didn't know it. Every time you take an Uber, PayPal and their owners get a cut.
Interesting. I did not know that.
Okay. PayPal, Booking, Ticketmaster. Have you ever gone to a concert in the last 12 months? That's Braintree. PayPal owns that. That's so 500 billion of 5 trillion global enterprise spend goes through Braintree. Effectively, PayPal owns that. And what analysts have been worried about was that when they made that acquisition, it brought the overall margins down, even though cash flow per share went up, revenues per share went up, earnings per share went out. It brought the gross margin down because you can't charge 3 points on Uber. They're not going to use you that you can charge 3 points on a small business guy with a website that's more than willing to pay 2.5 or 3 points because they have small volumes and they understand that that's it's easier to set up and easier to use and all that stuff. So the one thing that Chris alluded to on the previous earnings call, not this earnings call, was a margin inflection in Braintree. The minute you start to see that, and we did see margin expansion this quarter, but people were overwhelmed by the soft sandbagger guidance, you're going to start to see a re-rating. So to give you an idea what that means, Aaron, the stock is traded at 30 times earnings historically. That's its average earnings multiple. It's currently trading at 11 and a half times forward earnings estimates right now. And what you're going to see is that 510 winds up being 6 or 6.5, and margins start to expand. And not only do you go up because earnings go up, but you're going to go up on a re-rating as margins go up and earnings go up. So from 11 to 15 to 20. And at some point, we'll be back towards 30. People can't imagine that right now. But if you were at the average historical multiple today, you'd be a $150 stock. Never mind growth, never mind margin expansion, never mind all that stuff. So we think this can be an easy double over the next 12, 24, 36 months. And the market will figure it out later. But the name of the game is he set the stage. He set expectations extremely low right now. Market didn't like that, and he's going to crush it every single quarter. And this is the guy who, with the 15 handicap, winds up shooting 74. And you say, how did that happen? It's because he was never a 15. He always saw. He just set expectations very low.
Yeah, so if Chris was taking you out to golf and he told you he wanted 10 strokes, you'd be a little skeptical on the first tee.
Exactly. And that's basically what he'd asked for. He said, give me 10 strokes. We're going to have 2024 is a transition year. I need 10 strokes. And then he's going to just knock it out of the park.
So, I mean, it must get, I don't want to say lonely, but like when because you're specifically targeting stocks that, like PayPal, are beaten down and out of favor. I mean, it's probably, feels like it's like when you were bullish in the overall market, when everyone else is bearish, everyone's probably like, oh, you want to touch this? PayPal's, awful. Look at the chart. It was just a COVID play and all this. I mean, what do you say to people, I guess, that are kind of, I guess, either like perma bears on PayPal?
Yeah, I love it. Look, if you didn't have this extreme of sentiment, you couldn't have outperformance over time. So if that sentiment didn't exist, I wouldn't be able to do what I do. All the companies I get in, I'm getting in. I have two filters when I enter a company. And we own PayPal in across most accounts are in the mid 50s, but it's immaterial whether you buy it at 70 or you buy it at 50. This thing is going to be double or triple. The key is that the filters we look at are number one is if this goes to zero, do they carry me out in a stretcher? And if the answer is yes, you either have it sized too large in your portfolio. Now, we run a concentrated book, 8 to 12 companies at any one point in time. So we do run concentration. But the expected return for the rest of our portfolio, if one company went to zero, we're still going to be able to outperform over 36, 48 months because the rest will pick up the slack with outperformance. The second filter in the case of PayPal is if we walked into the board of directors and offered to take the entire company private at the price that was quoted in the market today, would they call security to have us escorted out of the building because the offer was so ridiculous? And if the answer is yes, that hits our filter. So one, it can't take us out on a stretcher. And two, it can't be at a price where the board would actually entertain it. And right now, if you were to walk in and say you have financing from JP Morgan to take the entire company private, anywhere near today's prices, they would have you escorted out of the building. One, they'd be insulted. Two, they would think you were a lunatic. And three, they wouldn't even meet with you. They would say, get this schmuck out of the building. He has no idea what he's talking about. Because just on a cash flow multiple, I mean, they're going to generate another $5 billion of cash, buy in $5 billion of stock this year. There's nothing to think about. This thing, in an LBO, the minimum you'd be able to even entertain would be $100 a share, minimum.
Got it. Which would put it at around $100 billion market cap. It's at around 63 right now.
And by the way, if the board accepted an offer like that, they should all be taken around back and shot. I mean, it would be absolute theft from the shareholders.
Yeah, it's like when back in the day, someone tried to acquire Netflix and Reed Hastings said no. And I think it was Icon tried to come in and buy Netflix and they said no. And people were like, well, you have to. It's in the shareholders' best interest. And he's like, no, it's in the shareholders' best interest not to take this offer. So just because something would be a good, short-term return to the shareholders doesn't mean that necessarily that's the best outcome for the company in the long run.
100%.
What do you mind if I ask? Like, when did you enter a position in this?
Yeah, so across accounts, we have a lot in the mid 50s and some in the mid 60s. So blended basis, call it $60. I probably a little less than $60, but in that neighborhood.
Hey, so I could get in right now at a lower cost basis than you, and you've done all the research. I like that. That's it makes my job easy.
Exactly.
All right, Thomas, do you have any other individual stocks you want to chat about while I got you for a couple more minutes?
Yeah, we like Baxter. This is one that we entered in the mid 30s. 53% down off pandemic lows. It's another multiple D-rating that's going to be re-rated. It's historically traded at 18 times. It's trading at about 12 and a half times forward. The reason it's trading is because the kidney renal care business is the slowest growth part. They're going to spin that out to shareholders before the summer, which means RemainCo is going to have a much higher growth rate and get back to its historic long-term average, call it 18 times, just on the re-rating. Plus, they are re-accelerating cash flow, margins, earnings since COVID. All these companies, they overstocked during COVID because they couldn't get product. They're a medical device company. Then they had to work through all that excess product over, call it 6 quarters, whether it's Intel, whether it's Generac, whether it's Stanley Black & Decker, whether it's Baxter. It's all the same story. Canada Goose, they're all the over-inventoried, worked through. Now revenues, margins, earnings, cash flow, all re-accelerating, but people are still stuck in recency bias, looking in the rearview mirror, just like all the people were bearish at the bottom in October 2022 because they were stuck in recency bias, looking at the prices go down in the previous 5 months, and they missed the opportunity of a lifetime. Now the market's up 40 some odd percent, 45% off the lows, and now they're just starting to get interested. And we just have to suck those folks in, and that's when we get our 5 or 7% pullback to shake out the weak sisters, the new money, and then we can resume the uptrend. Because, as I said, after a 2-year consolidation, you don't want to get too cute when that's breaking out. Maybe we retest the breakout level, but we're constructive for the next foreseeable future.
Yeah, and of course it'll be we've got more rate decisions and stuff like that coming in the next month or so. So it'll be interesting to see, what's happening. Obviously, Nvidia's earnings tomorrow after the close. That'll be a big one for the tech market because, if if Nvidia somehow, some way puts out like bad numbers, like they don't even meet the expectations, let alone, because for me, not to, I know we're not talking about Nvidia that much, but if they don't put out a quarter that like blows the numbers out of the water, then I think you could still see a sell-off even on a beat. And so then if they don't beat at all, if they miss and then Nvidia's down 10% and then, that trickles into Apple and Microsoft or whatever, we could get that pullback that people are looking for this week, but that's a big if because I think, again, the market's expecting some good things out of Nvidia. So, all right, those are Tom's 2 picks for the day. You got PayPal, ticker PYPL, and Baxter, ticker BAX. I'll throw those in the chat if you guys want to go check them out. And again, you can look at all the fundamentals, the chart, what I'm doing right here on Benzinga Pro. So, Thomas, anything else you want to leave us with today?
Yeah, the only other company we've been spending some time on is Canada Goose. We built some position at 11 and change. This is a luxury jacket retailer. And basically what happened is they got a problem in the wholesale channel. They've moved all of their production or the majority of it in-house. Same type of problem. They couldn't get product. They've worked through excess inventory over the last 6 quarters. They've got a 5-year plan to take it from 1.3 billion in revenues to 3 billion in revenues with 30% EBIT margin, which implies $6 to $7 a share earnings. They're running ahead of schedule. If you look at any of their stores, they're basically the Apple store of luxury jackets. This is a cash machine. It's family owned. It's been around for 50 years. Most people don't know that. The son is running it, owns 20% of the stock. He is executing, and I think it's going to surprise people now that everything's starting to inflect. And by the way, everyone's so bearish on China. Asia Pacific was up 62% in the most recent quarter that they just reported a few weeks ago, largely driven by China. The Asians love these jackets, and North America and Europe is going to start to improve. Their gross margin has expanded by 15 points over the last 5 years. Their revenues have tripled over the last 5 years. Stocks down on those COVID-based inventory issues, which are now largely worked through. We think the stock can start to inflect. And with all these names for us, these are all 12 to 36 to 48 month plays. We're looking for doubles and multi-baggers. We're not looking to make 20% and get out. That's my
type of style. I like that.
Yeah. So that's how we think about it. So I think Canada Goose is one with a little more risk and a little more reward to keep on your radar.
Where you're out in New Jersey, right?
I live in Connecticut, and
Connecticut.
our business is based in New York City.
Got it. Okay, so you're in the Northeast. I'm sure you see a lot up here in Detroit in the winter when it gets real cold. You see a
Yeah.
bunch of Canada Goose jackets around. I know a bunch of my buddies in Chicago. They got real tough winters there too. Wear them and actually say that, like, they're expensive, but you get what you pay for in the sense that you're not going to be cold in them. The one, I guess, like, fear I have with stuff like this is I do know a lot of luxury right now is dealing with a lot of like counterfeits and fakes, and a lot of people are maybe instead of buying a Chanel bag, they're buying what looks like a Chanel bag, but it's not. And there may be some of those for Canada Goose out there. But overall, I mean, if because China's the big market for Canada Goose, right?
China's the big market, and that's why they've ramped up their Apple stores of Jack. Like, if you ever go into one of the Canada Goose stores,
Yeah, we have one. We have one here, and
it's gorgeous, right?
Yeah.
I mean, it certainly is on Fifth Avenue in New York City, and it's literally like an Apple store, and there's lines outside. Like, you can't even get in, depending, if you're on the weekend or whatever. The Chinese don't like counterfeits.
Right.
The irony is they know
they come from China. Yeah.
They come from China, but so by lowering the low margin wholesale channel and increasing the direct to consumer, which is 70% gross margin business, all the Chinese want to buy Canada Goose jackets. They only want to buy them in the Canada Goose store, so they know that it's authentic and has that lifetime warranty. And that's where they're getting the growth, where the greatest demand is, and where people actually do not want to buy counterfeits.
So by almost in a proxy, like by buying Canada Goose where it's the stock's at now and it's, beaten up, and that's what you've been looking for is beaten up names, you're kind of in a way like betting on the Chinese recovery.
100%. By the way, this is for the folks who are nervous about the China recovery. And we have a big position in China in Alibaba. We like that story here. But leaving that aside, for those of you who don't want to play directly because of all the different noise around China, this is an indirect play. So, some people play it through Estee Lauder, some play it through Nike, and some play it through Starbucks, or different ways, kind of quote unquote safe ways. This is a more direct, leveraged way to play it. For those who are amenable to a little bit of volatility, because it's a small cap name,
right?
And it's going to take a little while to get the recovery hitting on all cylinders. But when it goes, it's going to go.
And is it one of those things where if you're looking at Canada Goose, you can be like, okay, well, even if China's economy continues to struggle over the next year, like this thing is not going to go much lower than it is right now?
Yeah, I mean, it's mind-boggling. If you laid out a chart of the cash flow per share, revenues per share, earnings per share, gross margin expansion, you'd just say, well, how is this stock even down? And how it's down is basically the rear view mirror inventory issues, which the market is struggling with believing are over. But if you actually go through the earnings calls and through the progression of the process and how the owner, the son of the founder, has been executing over the years, you would say there's something here and I should have a piece of this. And that's exactly the conclusion we came to after a lot of research. And we're patient. If it goes lower, we'll use the opportunity to add more. And if it goes higher, we're perfectly content with what we have.
Got it. Well, last question, Tom, and I'll let you get on because I know you're busy. But I mean, we've talked about now 3 stocks in very different sectors. Have you played like other retail names like Canada Goose before, or how do you pick between PayPal, a fintech play, a healthcare play, and then a retail play? I mean, all kind of you're basically looking across the board for anything that meets those filters.
Yeah, I'm looking for high quality businesses where the price, the short-term voting machine based on emotions is at an extreme, and the long-term weighing machine, the fundamentals are actually either inflecting, bottomed, or starting to improve. In most cases, starting to improve. And when you look at the price relative to the positive fundamentals, the dislocation is so large. That's where you can get excess returns and excess alpha. Playing the time arbitrage game. So the name of the game with all of these is if you're not on leverage, you can wait till the price, just as it's so emotionally despondent with a contracted multiple on the downside, at some point, 12, 24, 36 months, when that flips, it's going to be so euphoric and optimistic, and the multiple is going to be higher than it should be, and that's when we start to lay it off. When it starts to price in more growth than we believe can happen.
But you're taking advantage of these market inefficiencies on both sides.
That's right, 100%. So that's where we benefit, and we have this kind of these spidey glasses where we can see under the surface by, God forbid, doing fundamental research and understanding the cash flows, understanding the balance sheet, income statement, et cetera. And with all these turnarounds, the number one analysis you're doing, because they're priced so low and the margin of safety is so high, is you're doing solvency risk. And if you can get comfort that they have enough free cash flow to service their debt, refinance their debt, strong enough balance sheet, then you're just playing the time game until the market recognizes what you do and you give them enough runway to recover. But what's happened in COVID has created so many once in a generation opportunities on a company by company basis. And there are many of them still out there beyond the Magnificent Seven that a lot of money is going to be made by those with enough courage and experience to go a little bit against the grain in the short term. And as we look out, the interesting thing, after the first rate cut, which groups outperform the first 6 months, and no one's positioned for this right now? Value outperforms growth, and small caps outperform large caps.
Interesting. So, I would have guessed the small caps, but not that value outperformed growth.
Yeah. So no one is positioned. Everyone's in the Magnificent Seven right now. It's a little bit crowded. Everyone's short China. And I think what you're going to see, and by the way, international starts to outperform domestic. So as you know, the weighting of China, although it's come down, is still material. So to get that outperformance in international, you'll have to see China start to bid. And you're seeing the government start to panic. I think what they need is a good, kind of protest with a bunch of unemployed 25-year-olds calling for Xi to resign, and then he'll panic and finally do the big bazooka stimulus that everyone's been waiting for, and the thing will be off to the races and never look back. Certainly for 2 or 3 years until they hit the demographic cliff. But I think they've got one more parabolic move in China, and then it's over. It's going to be more like Japan. But I think you're going to see a lot of positive things. I mean, the sentiment, the positioning, everything couldn't be more despondent than it is right now. And for most of the highest quality companies, they're still growing free cash flow. They're still growing revenues. And when that recovery hits, they're going to hockey stick.
Yeah, I mean, I've been buying BABA in my long-term portfolio because I'm just looking at the valuation and I'm just like, all right, like, come on, this is like, do I think like China is still the United States' biggest trade partner? Yeah. Do I think we're still going to be doing business with China in 10 years? Yes. Okay. So do I think, Alibaba is going to be fine long term? I do. And so it's just so cheap right now. But all right, Tom, we've had you on the line now for about half an hour. Thanks for hopping on. I know we've gone on a little longer than I said I'd keep you. I know you're busy. I got to ask, so I know I want it on the record. What's your handicap? So if we ever play, I know you can't try to sandbag me.
Okay. I started in earnest. We joined the local club here 2 years ago. So okay. I'm a 15-2. Okay. And I think that's going to come down though. So right. I'm going to be the antithesis of a sandbagger. I mean, my goal this year is to get down under a 10. We'll see if that's possible.
Nice. You do any off season, like simulator work?
Yeah. Yeah. I got a simulator in the house and,
all right. Yeah. All right. You have no excuse to be above a 15 then with a simulator in the house. But
yeah, been getting the putting going. I just got to get the short game in gear, which I think I can do over the next couple of months, and this should be a decent season. We'll see.
Awesome. Well, we've got some beautiful courses up here in Michigan in the summer. If you ever find yourself in the area, then we'll take you out. But Thomas, thank you again. And hopefully we'll get to chat soon. I'll reach back out in a couple months and maybe we can do an updated outlook on the stocks we talked about today.
That'd be great. Thanks so much, Aaron.
Of course. All right, guys. That was